will talk about the Volkswagen and Porsche merger case. Our presentation is structured in six parts: the definition, background, motivation, timeline of this event. Then we review three articles and analyze the impact of this case. First, what is hostile takeover? It refers to the acquisition activities carried out by the acquisition company without the permission of the target company. The key characteristic is conflict, which means the board of directors of the target company is reluctant to give up their control, while the acquirer may buy stocks through secondary market or use financial instrument to lock the target company's share. Let's see the relationship between Porsche and VW. The top management came originally from the same family, and the founder of Porsche, Ferdinand Porsche, also made a great contribution to Volkswagen as an engineer. But Volkswagen has a more political background. It is a state-owned company, and whatever the well-known Porsche 911, the SUV Model King, or Panamera, each of the Porsche company's products are targeted on the high-end market. Porsche accumulated a large number of cash from 2001 to 2005. To be specific, the net profit margin and AOE suggested the Porsche is more profitable. Even the size of Volkswagen is bigger. It has a lower PB ratio and less flexible company governance structure.
So what are the motivations of this takeover? Basically, Porsche saw the opportunity from the depressed stock price of Volkswagen and its own high profitability. In the year 2005, Volkswagen was larger than Porsche in terms of book value, market capitalization, and annual sales. However, its profits and return on equity were dissatisfying. And in contrast, Porsche was performing very well in these numbers, and its net profit margin almost doubled from 2001 to 2005. Its high profitability brought strong cash flow and high liquidity to finance this takeover. Now, let's conduct a SWOT analysis of this takeover. First, it generates economies of scales as they are in the same industry. And then, gaining control over Volkswagen allows Porsche to make decisions in their own interest, and they can guarantee future cooperation in technology and productions. This takeover also brings Porsche new customer segments as the two companies have different market positioning. It also sustains Porsche's own business model. However, the huge debts generated from this process may be a threat when impending recessions deprives its profitability in the future. And also the brand Porsche loses exclusiveness, and the VW law might impede the process of takeover in the future. Now let's look at the timeline of this event.
First, in 2004, due to some wrong decision and historical problems, it produced a higher cost in Volkswagen. It had to sell its equity capital. However, Porsche made a higher profit, which made it able to do some investment. From 2004 to 2005, Porsche secretly bought 10.3% of VW's share from secondary market. Continually, in October 2005, through investment banks and others, Porsche increased its stake in VW to 18.53%. In November 2006, Porsche paid 4 billion euros for about 10% shares, and up to then, it owned 27.4% of the company. In 2007, through second market and block transactions of financial institutions, Porsche increased its holding by 3.6% and reached 30.9%, thus becoming the first shareholder of VW. However, the VW Act states that no shareholder can exercise more than 20% of the voting rights, even if he owns more shares. Porsche borrowed money to buy shares and ended up with 42.6% of VW's share on its books. However, Porsche has also had to bear lots of interest.
In the third period, Porsche was likely to go bankrupt and VW stock would plunge, so some European capital borrowed 10.4% of VW's shares to short the company. However, in October 2008, Porsche pronounced that they had locked 31.5 cash settled call options in bonds secretly, plus 42.6% common stock for a total of 74.1%. Excluding the shares held by the government, only 5.8% of shares remained on the market. So finally, Porsche negotiated the sales of 5% of shares to reassure the market. In the last period, Porsche's profit plunged after the 2008 financial crisis, having a liquidity crisis, so they had to make a proposal to VW to merge the two business. However, in July 2009, VW began its reverse takeover plan, acquiring 100% of Porsche AG. At the end, Porsche SE is the largest shareholder of VW, holding 50.7%. At the same time, VW is the 100% controlling parent company of Porsche AG.
Research by Jennifer J. Hale has shown that, in spite of the apparent promise of open capital market offered by globalization and convergence theory, protectionism is on the rise internationally by introducing the famous Railway Road and Unicorn Road. And back to our cases, the war between Porsche and Volkswagen did somehow indicate the conflict between the German government and the EU. Research by Stowell introduced the complex equity derivative position connected with the VW merger case, discuss how exposure can be created without prior disclosure.
Hostile takeovers and correction of managerial failure by Julian and Colin concludes that there is high board turnover and significant level of restructuring after takeover. But as the results show, high board turnover does not derive from past managerial failure. So hostile takeover do not therefore perform as a discipline function.
Okay, now after the summary, I will further discuss the impacts of the takeover. Now let's start with the positive effects. The first one is portfolio effect. The combination of perfectly complementary product lines and target markets will increase profitability and reduce cost. Plus, Volkswagen can infuse the cash needed into Porsche to get the ailing firm out of its financial doldrums. The second one is that Volkswagen gets one step closer with the global #1 position in the auto industry. According to the following graph, you can see that compared with the beginning year of the takeover, crucial indicators all have experienced a several-fold growth at the end year. Now let's move on to the cost. First, debts. Both two companies had taken on heavy bank loans during the process, not to mention the interest from that. Besides, Volkswagen will have to pay hefty taxation costs, and there is risks of possible suits from hedge funds. Now with the merger, the new company is larger and more debt-ridden, so corporate governance will be a tough issue. The failure of integration between corporate cultures will affect the normal operation of the enterprises. Hostile takeovers often lead to widespread redeployment of senior staff, mass layoffs, and disruption of a company's long-term approach. Balance of all parties should also be concerned, such as how to balance the interests between the companies, between the shareholders, and between the company and the government. And next page is our reference list, and that is all about our contents. Thank you for listening.
Bye.